Hi, everybody. I'm very happy to for our weekly Thrive in China round and influenza A, and was with high fever and temps as well as my children. So I've been sort of bedridden for quite a while now. But we're back at it with the weekly Thrive in China roundtable. And on this week's episode, we're talking about how to avoid a tax audit in China. Having personally gone through a tax audit, it's something that I do want people to realize can happen to them spontaneously. And I do want to explain to people how it can actually pop up, why it would pop up, and some tips on how we can prevent it from actually happening. And then we have a very interesting, debatable question at the end of the session as well. So how the roundtable works is that I'm here to teach you a little bit about certain topics on a weekly basis. This week it's about tax audits. You may have questions. My philosophy is that when there is a question on China, there is no dumb question, so ask away. This is going to be your value add, your time spent. This is a complimentary roundtable, so any questions you might have, don't hesitate to ask. From a technical standpoint, just to highlight, we're using Zoom meetings. If you run into any technical difficulties, just jump off, try to jump back on with your link. I am recording today's session, so you can also on replay at your own convenience. Who's the expert for this week? It's myself. My name is Kristina Koehler-Coluccia. I'm the head of business advisory at Woodburn Accountants and Advisors. I am a leading expert on inbound investment into China. I have 17 years of on-the-ground experience in Shanghai, specifically in inbound investment within corporate services and corporate compliance. So basically, we help companies to handle all of the administrative functions that have to happen when trying to be compliant whilst transacting and doing business in China. And I highlight that because it does not necessarily mean that companies have to have an entity in China. We work with both sets, those that do have entities and those that don't. We've worked with over 500 companies on their inbound investment into the region, specifically Hong Kong and China. We've helped them with their pre-investment strategy all the way through to the implementation of these strategies, and ultimately understanding how they can scale and systemize their business in the market. We have a series of standardized methodologies that we create for our clients. And if you're interested in understanding more about those, you can find the links on our website and watch those webinar recordings as well. If you haven't received a copy, we wrote a book on the 10 big that companies make in China. A lot are from personal mistakes. If you're interested in getting a copy, because you should always be learning from those that have made mistakes, then just email me at Kristina@woodburnglobal.com. It's a fun, short read, has wonderful case studies explaining a little bit about what not to do whilst doing business in China. So to start off today's presentation, we're looking at how to avoid a tax audit in China. And the first thing we're going to look at is the risks of accounting in China. So let's face it, when we're doing business in China, whether it's due to cultural influences or the fact that there are language boundaries, the last thing we want to have on our plate is receiving a visit from any form of authority bureau. But I always say there are two bureaus I don't want to be visited by. One is the tax authorities and the other is the Labor Bureau. Now, any well-intentioned business, foreign investor, foreign business going into China, they're trying to lead a very honest business. They're trying to be compliant. But this does not mean that mistakes don't happen, right? Whether it's through unqualified fapiaos, which maybe you didn't even know existed, supporting documents, because in Europe, that's okay if there are documents that are missing, to simply mistakes being made either by yourself, because you don't know what you don't know, or employees, which are fundamentally created because of communication barriers. Oops, sorry, I don't know what just happened there. Let me go back to the slide. So, there are always going to be risks when it comes to accounting. And what we want to try and create is a financial department that maintains complete and accurate set of books according to PRC regulations at a minimum. And we want to create a structure in China that is tax optimized, not that is evading taxes. A lot of companies, even those that have financial capabilities, have the tendency to have a mindset of going into China and saying, I'm going to outsource the finances because the business isn't big enough yet to warrant an in-house finance team. So I'm going to outsource the work to a local bureau or to a local company where I will probably incur language difficulties. But in any case, I've got the staff in-house that can do that, but they don't have an accounting background. Or simply because they're so China-centric, they maybe have never even worked with a foreign invested company before. There are so many risks when working with firms like this. And if your mindset is to just focus on cost and saving costs on the vital functions that have to occur within your company, you are not going to scale and systemize your business the way you want to. Invest a little bit more in the vital functions around your business. And for me, finance and administration and compliance are key. You don't want to take 4 steps forward with your business to then have to take 6 steps back because you've done something wrong with the foundation of your business. Because truly that can halt your business, meaning you're not going to scale up simply because you're not systemizing the vital functions that have to occur. Okay. Now, first of all, you all have to realize tax audits can occur. And I'm highlighting in this presentation 4 scenarios where it could lead to a tax audit. A poorly set of books not only creates additional tax liabilities for the business, but if audited, it can actually require you to submit a lot more documentation than you would have ever created to the tax officers, causing you ultimately to hold your business for a period of 2 to 3 months while this tax audit occurs. Generally, tax audits will not occur as you are in your startup phase. So normally the rule of thumb is you will be audited or could be audited after a period of 3 to 5 years of operation, because they're going to reflect back on the previous 3 years of your operation. Now, to avoid any of the difficulties that you might have with tax officers, with going through a tax audit, we want to make sure that the fundamental aspects of your finances and your taxes are there, okay? Prevention is the best form of protection. Don't skim out on the key functions that are surrounding your business, okay? Particularly those that have an impact with certain government authorities, like the labor authorities or the tax authorities. Now, I'm going to highlight today 4 scenarios that can lead to a tax audit in China. Scenario 1, very simply, is getting reported to the tax authorities by anybody. So in China, guanxi relationships are vital. You want to create solid foundational relationships with the right people, okay? Even if you have a falling out with somebody, you still want that relationship to be strong so that it cannot damage your business in any shape or form. Because if you have a falling out with somebody, whether it's an employee, whether it's a third-party provider, whether it's your clients, whether it's your suppliers, they can always, if they want to damage your business or have leverage over you, they can always report you to any government authority with or without any substantive cause. Meaning that just filing a complaint with the tax authority saying, I think they are doing something wrong, will mean you will have a tax audit that occurs. Or if you have an employee saying, I'm not getting paid the right social insurances, even though they are, a tax and social insurance audit will occur. So any denouncement the government required to claim that that party is doing it. And usually you will never know who's done it. It's clean. All right. Now, avoiding such a scenario is the best option, right? Unhappy business partners, disgruntled employees, minority shareholders, and even clients make up your most likely delinquents. Okay, they're the ones who are most likely to denounce you. And any tip will cause the government bureau or the tax authorities to come and investigate. I realize there's a lot of writing on these slides. You can always pause the video as you're watching this on replay to then read the slides. But there's no, I didn't want to put pretty pictures on here. I just wanted to really substantiate how it works in terms of getting reported to the tax authority. So it's really important, first of all, to make sure that your foundation is there. So when you're dealing with clients, when you're dealing with your employees, make sure the contracts are bulletproof, right? That you always can, you know, even if you do have an audit, you've got your contracts in place that are showing exactly what the relationships look like. Make sure you've got a sound finance system, accounting system that really will help you to scale and grow your business. Utilize people in your value ladder, like lawyers, like accountants, to really build this solid foundation for you, and make sure that you understand it. Build your knowledge base on it, okay? We want to make sure that there are multiple people within the organization that have certain responsibility levels, okay? You don't want to just let your finance person deal with the finances. You as a manager should also be responsible for your finance team and what they're executing and doing on a daily basis. How to implement all of this is actually through standard operating procedures, which will be the documents that the tax authorities will require to look at. And if you don't have them, it means that one of the exercises you will have to do is create them in order to then have the tax audit closed off. So again, as part of your foundation, establish standard operating guidelines, standard operating procedures, SOPs, for the various divisions that you have, whether it's finance, sales, production, sourcing, merchandising, whatever it might be, in case that tax audit comes up. Because what they will do is not only look at the financials of the company, but they will also look at how you're operating your business, all right? And verbal meetings is not enough. They will want to see that you have these things in writing. For example, how are you claiming discounts? You know, what are your decision-making processes to give a client a discount? Or, you know, things like this. So make sure you've got these contracts and standard operating procedures available. Now, just as a case study, I did want to highlight this. We were working with a Shenzhen company who had actually initially just a trading company, and over time their business expanded and they started doing very simple assembly within their company, but forgetting to update their business scope. A disgruntled employee actually called the police on them. An investigation was made, not only into the finance side of the business, but also into the administrative side, which is looking at the licenses, looking at the operations, investigating and seeing, coming into the office to see actually what was going on, where do people sit, how many computers are there, do the computers match the head count, all of these types of things. And then obviously seeing a corner of the office where simple assembly was occurring, which is basically repackaging, putting labels, etc., and realizing that it wasn't in the business scope. So luckily in this situation, the government provided a timeline for them to update their business scope before a penalty was actually going to be issued. And they did that straight away, and a penalty was absolutely avoided. But it's just to say that a disgruntled employee can do a lot of damage to the business. It meant that the general manager sitting in Shenzhen had to spend a period of 2 months under high stress to really then realize, you know, the focus was purely on that. It wasn't actually on the business and scaling up the business. So scenario one is very simply that anybody can denounce you, right? And any denouncement that is made, the authorities will take it seriously and they will come into your organization to investigate. Scenario two is red flags within your financial reports, okay? So what does this mean? Well, under China's golden tax 3 big data, the Chinese tax authorities now have the ability to detect fraud within the financial reports and tax submissions that are being made. The areas where they will investigate are the tax declarations, the tax reports. They will look at the quarterly financial reports. They will look at all of the FAPIAO information. They will look at the Social Security filings, because now Social Security is done and declared at the tax bureaus. They will also then simultaneously look at customs clearance, customs declarations, which are not necessarily under their regime, but they will still ask the customs authorities for that information. And then they will ask the Ministry of Commerce to provide the business registration information to see whether the company is in good standing. So the Chinese tax authorities have all of this data at their fingertips. And they have AI within their computer systems to detect, again, any form of fraudulent behavior, okay? So to give you an example, let's say the system recognizes a mismatch of gross salary declared between the individual income tax declaration report and the corporate income tax declaration report, okay? This highlights in the system, creates an alert, and the tax authorities will begin to investigate, okay? So just very simply something like this. Salary between III, individual income tax, and corporate income tax, okay? So they really will go through the details. And you know, the issue is yes, there are millions of companies that are registered just in the district where the tax bureau of that district, you know, pick and grab at random, which means your company might then get chosen, okay? So, you know, if you have consistent behavior of having consistent abnormalities within the financial figures, this is increasingly going to attract the attention of the tax authorities. If you are continuously going to your tax officer and saying, oh, I issued the wrong VAT FAPIA, oh, I put the wrong data on the VAT FAPIA, oh, I did a miscalculation on the corporate income tax rate, oh, I did this, oh, I did that, that will also be an alert for them to say, what is wrong with this accountant? What are they doing, right? And you've got to realize that your accountant, the person in charge of the finances, whether even if you outsource the business or outsource the finances, that accountant is registered with the tax authorities. So they will be alerted straight away for any abnormalities, and the tax authorities will want their questions answered, okay? Now, with any alert, so for example, the example I provided earlier in terms of the mismatch on gross salary between the individual income tax report and the corporate income tax report, the authorities are going to want to have supporting documentation, because it's not just that the tax authorities are saying, why is this occurring? No, they're going to say, why is this occurring? And please provide the supporting documentation to show why there is a mismatch. Okay. Now, most of the common fraudulent activities which business in China engage in is to minimize their tax liability. This is easily spotted through the big data. Okay. If you are looking to evade taxes in China, okay, it's going to be detected. So again, don't mess around with this type of stuff. We want to optimize our tax situation. We do not want to evade taxes. Okay. And there are a lot of ways companies could actually evade taxes, and I do want to highlight some of this today. And again, I want to say that it is all detected through the algorithms of what they call the big data. So what is big data, right? How do they detect fraud behavior? One is through reconciling data across multiple financial and tax reports filed with the tax authorities. So to give you an example of this, revenue, you are actually postponing the declaration of revenue because profits tax is declared on a quarterly basis. You've had some last minute transactions that have generated tremendous amount of income for you. In order to lower your tax liability for that quarter period and to help your cash flow, you are not going to book those revenues in, you're going to wait for the next quarter period. If you do this consecutively, every single quarter period, this is the authorities. The next is compare. So with big data, the ability to look at your industry and compare your results with other companies in your industry and sector. Now, this is exactly how my company got detected for tax audit. In our situation, we were doing better than the average, which normally people would say, that's good. That means you're paying more taxes. That means you're doing all of this. But as we were doing better than the marketplace competitors, the tax authorities came in and did an audit on us to see why we were doing better, what differentiates us from the rest. So although positive audit, it doesn't mean that anything wrong or booking things wrong. Because again, as a foreign investor and as a foreign leader and manager in the business, your knowledge is what you know, right? And there is so much to know about running a business in China that you always have a doubt in the back of the mind that perhaps you don't have the right team members that are educating you. In our situation, it was a very smooth tax audit. In our situation that we had to update, had to create and submit. But for us, it was smooth, but it just meant for 2 months, my focus was on this on a daily basis as my finance manager, which meant that for the two of us, we were not focusing on anything else for 2 months because we just wanted to get out of the audit, even though some might think it was a positive audit to go through. Ratio analysis is also very similar to comparisons. It's basically the tax authorities ratio analyses to benchmark financial figures against industry figures. So it's kind of a comparison as well, but they do this quite often. And the other is doing a verification, both quantitative and qualitative, between the tax systems, between the Ministry of Commerce, the labor bureaus, customs bureaus, etc. to for millions of companies that are registered in one district in one city, but they are doing it. It is becoming much more automated where red flag signs are coming up and being pinpointed. And each time there is a red flag, most likely the tax authorities will either question you, which will then always lead to a tax audit, tax investigation. So the question is, how, now, like I said, we went through a audit, right? Nobody denounced. We were just doing better than the average corporate service providers in our district, which doesn't always mean that they're all registered in the same district. They're not. But out of the few that were registered in the same district, we were doing better than them. And the big question was, why were we doing it? Now, the experience audit made me realize the following. So the question is, how did I survive? I survived for the following reasons. One, I really invested in my accountant, and I was very relieved to find out that my accountant, my finance manager, who is my right-hand person, did a fantastic job in creating the foundation of the company. And it just verified to me their knowledge level on our industry, their knowledge level on how we run the business. And we had basically, through their help, created a very solid foundation that meant we were doing better than others. In our situation, we keep two sets of books. One is a complete and accurate set of books according to PRC GAAP. That is obviously our priority on a month-to-month basis. But we also keep a second set of books, which the tax authorities appreciated, which are based on an accrual basis, which is a Western accounting mind frame. And so, you know, when they were asking certain critical questions about where we stand today, we were able to provide that information because we kept these two sets of books. So I do encourage companies, although there is no legal requirement to do this, There's the PRC gap accounting that you need to do. That's fundamental. But it's always good to be able to throw numbers out to your accountants to know exactly where the transactions stand on a day-to-day basis so that you're going through a smooth process, right? The next is for every single transaction that is running through the company, we have internal operating procedures that we need to have a complete set of documents. This is not just related to the FATCA, it is related to the service agreement or contract. It's related to the email orders that come in per client, because we might have a master service agreement, have certain revenue generating services that pop in are in this one agreement. So we keep track through emails of order client saying we want XYZ service. We have the confirmation going out saying, yes, we will provide it. We have then a full track record of this. And ultimately, then we also have proof of service completion. So in our scenario, for every single invoice that we issue, for every transaction that is occurring through the business, whether it's revenue, cost, or general administrative, have supporting documentation available. And again, I am in the industry of creating standard operating procedures, of being in compliance. So that's fundamental that we are actually doing this ourselves, but it is something that a lot of things that start off very small do not implement. And they think they can actually wing it. It is critical, vital that you create the system from day one, that you have the supporting documentation for every single transaction. Although we didn't go through a tax audit of the last 3 years of operation, we did go through a tax audit of the last 12 months of operation, and they do go through all of this detail. Now, your question after that might be, well, in China, we anyway have to do a year-end audit. So wouldn't the auditor, pinpoint all these things? It depends on the auditor that you choose. You might have Chinese auditors that are very nonchalant and they're like, yeah, we trust that you'll get the supporting documents. And you'll have others that will not issue a good status audit report without actually seeing the supporting documents. So it really will come down to the auditors that you're using. The next is, does my balance sheet reflect a realistic financial position of my company? So, if you have a balance sheet where actually you have over, 10 million RMB in receipts and no payables, I mean, it's such an imbalance within the balance sheet, red flags will be raised. All right. So make sure that your balance sheet is balanced, and that it truly reflects the financial position of the company. If it is not balanced and it's kind of lopsided to one degree, either on the assets or the liabilities, you've got to have the supporting documentation to explain why that's occurring and to provide the reasoning behind that. So again, it's really a matter of making sure the administration is there to support the business. So in this case, the case study, as I highlighted, is my own. It's our Shanghai entity that went through a tax audit, predominantly because we were more successful than others in our sector. The tax authority, our tax officer, had done a ratio analysis and benchmarking. And ultimately, what they went through in terms of the tax audit was looking at our standard operating procedures and operational guidelines. The line of questioning was on client acquisition. How many clients do we acquire per month? What is the client retention rate? And what is the billing mechanism with the clients? And what are the various types of billing mechanism that we have? So again, it really does go into the operations of the business. And if you don't have that full understanding, it's important. Now, I just also want to highlight here, they interviewed me, they interviewed my finance manager, but then they did request to interview 2 to 3 other staff members from various divisions to ultimately, the reasoning was to verify what myself and my financial manager was saying. The reasoning why they do that is because, generally speaking, if there is any form of tax evasion or naughtiness occurring within an organization, it will usually stem from the GM and the finance manager. So they wanted to interview other people to make sure or verify what we were saying in terms of how we acquire clients, what is our retention scheme, what's our billing mechanism. Scenario 3 is when you are looking to apply for a tax refund. Now, to give you a bit of foundation on this, okay? The tax authorities are there to generate tax income and to make sure as a company you are not evading taxes, but that you are actually declaring your taxes and you're paying something to the tax pool. Again, to give you a bit of background, I'm going to use Shanghai as an example. In Shanghai, you have a tax authority, or your tax bureau is the bureau that is sitting in your registered office address district. So you will have multiple tax bureaus in Shanghai. Every district will have their own tax authority, their own tax bureau. There is a competition between the tax bureaus in Shanghai on which bureau generates the higher tax income, right? It's a KPI that they have. So no, and then that also leads down and filters down to the fact that every tax officer has their own KPI of who's going to achieve the most tax income based on the clients that they have, right? That they are in charge of. So if you come now to your tax officer and you say, hey, buddy, I think I've done a wrong declaration. I need to apply for a tax refund, whether it's for VAT, whether it's for corporate income tax, whether it's for consumption tax, whatever it might be for, right? They are going to investigate. So you need to be really clear as to why you're applying for that tax refund. If you've paid too much VAT, why? If you've paid too much corporate income tax, why? Okay, or consumption tax, or whatever tax you're trying to get a refund on. What is the scenario that or the reasoning why you're asking them for this refund or this credit? Because most of the time they don't give you a refund. They will provide you with a credit that is then reflected on the next month's series of tax payables. Now, anytime that you ask for this tax refund, right, you've got to realize that your tax officer will be obliged to do a detailed analysis of your financials, maybe not just for the last 12 months, but it could be for the last 3 years, 36 months, to really understand whether you have the right calculations on hand to explain why you need a tax refund. Okay, so please, 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 don't just randomly tell your finance manager, oh, go to the tax bureau to ask for a refund because we think sure that your calculations are correct to make it a smooth discussion with your tax officer. And I would almost go in with a project file to show your calculations to, again, smoothen the tax audit process. All right. This is something where you should not be nonchalant about, right? If somebody denounces you, or, the tax authorities have done their own investigation and I want to do an analysis to compare you with the other people in your field or sector, fine. But really, if you're going to the tax authorities because you're asking for a tax refund, this is you opening the can of worms. So you've got to make sure that you have the backup data to prove it, okay? In this scenario, and I've highlighted and read on the slide, tax planning, proper financial controlling are key things that you have to think about when you're going through this step. And your finance manager needs to be overly confident in approaching the tax authorities in relation to this. Scenario 4 is in regards to the legal entity liquidation in China. Now, we all know that during the pandemic, well, basically since 2020, companies have been exiting the Chinese market just because with the current situation with lockdowns and difficulties on a global scale, companies are exiting the market. So what does this mean? It means that actually you are deregistering, liquidating the company you have established. When you go through a liquidation process in China, it is a process. It is standardized, okay? There is no way you can avoid that the tax authorities will do a tax audit on you. This is part of the standardized procedure. And depending on how long you've been established in the market, generally speaking, they will do a tax audit on the last 3 full years of operation. So if we're now in April 2022, they will look at 2021, 2020, and 2019. Okay. Now, the tax audit for the last 3 years of operation is that you will have to hire actually an auditor to do a closure audit, a liquidation audit on the business, and they will have to look at the last 3 full years of operation. This audit is then submitted to the tax authorities, who will review it, but then do their own calculations on all of the various tax liabilities, whether it's income, individual income tax for your employees, corporate income tax, VAT, consumption tax, whatever it might be. They will go through all of that. Stamp duty tax is another one that I want to highlight. They will go through all of that. In addition, what they will also do is that you need in that process to give back all of the VAT FAPIAs that you might have on hand. So anything that you have on hand associated with tax filings or VAT issuance, all has to be submitted back to the tax authorities. So I just want to highlight here, I don't know if I have this as a case study actually, but I don't have this, but I do want to highlight a liquidation that we went through where it was a joint venture that was extremely mismanaged. No organization, no compliance procedures, no standard operating procedures, where when the tax authorities were asking to get the FAPIAs back, and I just want to highlight that when you are actually operating in China, you purchase FAPIA booklets from the tax authorities. So they are keeping track of all of the FAPIAs that are being issued to the authorities, or sorry, being issued to your clients. And it's all tracked within your VAT system, that they turn back the FAPIA sheet. This specific client could not give them back. They had lost those FAPIAs. And depending on the value of each fund, that is your penalty that you then need to pay back to the tax bureau. So they had actually about, I believe, between 10 and 12 FAPIAs that were missing. So the total came to between 100,000 to 120,000 renminbi as a penalty that had to be paid back. Now, when this sort of thing happens, the tax authorities will not complete the liquidation process, meaning they will not give their stamp of approval to liquidate the company until this penalty is paid back. And obviously, when you're going through a liquidation process, you don't want to go through this hoopla. Actually, what you're trying to do is save costs and not pay more than you should have to. And so actually, the decision-making process by the JV partners was that they were not risk the fact that they were going to be put on a blacklist and potentially not be able to invest in any other entity in Shanghai again. So there is, when you're going, again, it all comes back to creating that sound foundation, right? When you are trying to avoid a tax audit in China, not avoid, and this is a scenario you can't avoid it, it's part of the actual liquidation process. You've got to make sure that your corporate governance is there through the standard operating procedures, that you have the vital people within your organization, whether they're outsourced or in-house, taking care of the business, right? You have to consider the business as a baby, and they have to make sure that baby is going to grow and scale up into an adult, and make sure that all the compliance procedures are there, the rules and regulations, that you give a child to grow up to be a proper citizen, right? Proper resident is being done. So again, think about how you're going to instill within your organization these compliance procedures to make sure that you are protected. And ultimately, when we're talking about tax audits in China, the goal is tax optimization, not tax evasion. Now, a lot of this is happening now as well due to the pandemic, but just generally speaking, in order for companies to be able to scale up, they are looking for investors, whether it's Chinese investors, APAC investors, global investors. They're looking for investors to come within the organization, or it could very well be that you are looking to get acquired. Now, this happened again to me 5 years ago, where our company back then was acquired and we had to go through an investor audit. Whether you go through a tax audit from the Chinese Tax Bureau or whether you go through an investor's audit to then look at the actual valuation of the company, it's heavy. All right, this is serious stuff. Now, you know, whether you're looking for an investor audit or you're getting audited by the Chinese tax authorities, the principle is the same. You want to have a company that is in good standing, that is clean, where the investors or the tax authorities have the ability to perform financial analyses and reviews of your organization, and everything just makes sense, because investors will look at your numbers from top to bottom, bottom to top, right to left, left to right, to really understand your business and absolutely to evaluate the company, right? The minute that something is not proper, that will lower the valuation of your organization. So you want to make sure that not just your financial status of the company, but the administrative status of the company is in good standing. So I just wanted to add that in as kind of a point that even if you're not being investigated by the Chinese tax authorities, if you are eventually looking to get acquired or you are looking to add investors within the organization, you still want your business to be proper, okay? There should be no excuse to think about how to create that foundation. So how to avoid an action plan, basically, for you to avoid a tax audit or to minimize the pain associated with going through a tax audit. Number one, don't outsource the vital functions of your business to cheap providers that are not going to take care of the business. Number two, gain knowledge yourself. All right, understand what needs to happen within your organization to have a clean set of books, to have a full understanding of where your status is for your company from an administrative perspective and a financial perspective. Three, maintain a complete and accurate set of books. Look at them on a monthly basis and adjust them as quickly as possible so that you have a recurring set of cleaning books from month to month, okay? I don't know what number I'm on now. 5, your financial department should be aware of scenarios and guide you towards better financing. Make sure that you are spending money on these people. You want people who've got experience, not new graduates. You want people who've gone through these types of situations to properly guide you and push you in the right direction, okay? 6, your finance team, your administrative team, your senior managers must be involved in creating the standard operating procedures, operational guidelines, and they must be proactive in their minds in terms of protecting the business. We're always trying to find loopholes to look at how we can optimize the business. What we don't want to do is get into illegal situations where we are risking the company and ultimately risking then the valuation of the company, or risking the fact that we can become penalized by the tax authorities because we're not doing things right. Just some tips, as I said, be proactive with all your divisions, but ultimately as a manager, as a leader, as an entrepreneur, be proactive with your finance team in China. Again, whether they're internal individuals or external individuals. What this means is produce monthly financial reports in China. Think about whether you're going to have 2 sets of accounts, PRC GAAP accounts, minimum requirement, or as well as a second set of accounts, which would be the accrual accounts. Read those reports immediately. Set up calls with your finance team or have meetings face-to-face with your finance team to discuss them line item by line item, right? Analyze those reports. Now, I think you should just be analyzing those reports to be able to pivot your organization in whichever direction you need it to pivot into, but it's also to make sure that your company is remaining in compliance. Always raise questions. I always say there is no dumb question when it comes to China. So raise your questions, make adjustments when and if needed. Don't wait on that. Create operational guidelines and keep rigid systems to make sure that those guidelines are being maintained, all right? I say have rigid control systems. You also have to have the mindset of being flexible, okay? These are just guidelines that should be amended and adapted as you grow and scale your business. They're not fixed in stone, but you do need to make sure they're being implemented by your team. So I wanted to highlight today a question. Can a tax audit be considered something as positive? Now, most people would probably say, no, I mean, getting audited is just painful. I used to say, actually, I might be over dramatizing this, but I actually used to say that the experience I had when we were being required in terms of being audited, it felt like I was being raped. Like every single bone was being torn off, my soul was being ripped apart, because this was a company that I had created from scratch. It was my baby, and it was being pulled thread by thread out. It was painful. It was so painful to watch. And obviously, when you're being audited, people do not focus on the good that you have done. They focus on the bad that you have done. And we're all human. So there's always going to be mistakes that we make. There's going to be failures that we make. And that's what they focus on. And it is an awful experience. What helped as we were being acquired was the fact that we had just gone through a tax audit. So I was somewhat prepared mentally for this exercise. But it did mean that the tax audit actually cleaned us up, because we created further standard operating procedures that were small pieces of guidelines that we had to create, but helped a lot during the acquisition audit. And it helped us just streamline and systemize the business better, because the questions that the tax auditors were asking us, the tax authorities were asking us for the tax audit, were very similar to the questions. So it was a very good prep, actually. So I do want people, even though you might be sitting on the edge of your seat when it happens and you'll be nervous for a period of like 2-3 months, I get it, I was there. Think of it in a positive light, that it is almost like a government authority is coming in and doing an internal audit to make sure we're okay. And they might highlight I had no idea about. I mean, I didn't know that we needed certain operational guidelines. Neither did my finance manager, for that matter. Again, we're human. We know what we know, which is why it's important to hire people that have this form of experience so that they can guide you appropriately. But if there's one tip I can make, having gone through the experience, is if it were to happen to me again, I would take it in a positive mindset and say, all right, I'm going through this tax audit. We're going to have to deal with it. It's going to be time consuming, but I'm going to take it as a learning. Whatever they suggest we do, we implement. This will help to streamline the business and help to create a better foundation. All right. So keep that positive mindset, because you'll need it, number one, but also always think we are striving to improve our business in China, because we're striving to scale and systemize the business. Every day, whatever company we have globally, we're striving to improve it, make it more efficient, make it better, right? And going through a tax audit could achieve that for you, especially in a place like China, where we don't know everything as foreign leaders, as foreign entrepreneurs. So can you consider it as something as positive? All comes down to your mindset, whether you think of it as something that will turn out to be positive. And obviously, if there are things that pop up that are not good, like penalties start arising because you haven't done X, Y, and Z, that also means you have to fire people. It means you have to fire your outsourced provider, or fire your in-house accountant, or fire your sales manager, because they're the people that have been helping you to grow the business. And if something has been going on for more than 12 months, you got to get rid of them. They're not helping your business in any shape or form. All right. So the tax audit is going to rock the boat, but hopefully it'll rock the boat in a way that's positive to help you scale up even faster. So just to finish off today's presentation, how you can work with me is, what do we do? We help people with incorporation advisory. We help people to set up entities in China. We do business scope benchmarking. We help to appoint supervisors, finance managers, non-executive directors into the corporate management of the company. We help with tax advisory. We also offer full outsourcing solutions for accounting, tax, payroll, compliance. And obviously this encompasses our clients, where we help clients go through tax audits if it does actually. I want to thank everybody who is watching this on replay for joining our Thrive in China roundtable. These roundtables are totally free to join, so schedule this time into your diary every week. Show up, you're going to learn something. Just note time registration, and you can join any, if not all, of the weekly roundtables that will be set up until the year's end. Just to give you an update, the next 4 roundtables this week, we're going to be talking about implementing an internal control system. Then we're going to be talking the week after about profit repatriation strategies. May 4th, how to start your business with your China accountant, and May 11th, how to write your business plan. And then we're going to be moving more into topics around marketing, strategy development, etc. for the summer period. So I hope you guys enjoyed this. If you do have any questions or you want to schedule a one-to-one, don't hesitate to reach out. I'd be happy to speak with you. I wish you all a very happy Easter. For those that are in Hong Kong, I know Friday and Monday are public holidays. And for those of you that are in Shanghai, good luck with the rest of your lockdown period. Stay positive, stay safe, and keep it up with your mindset. I wish everyone a great afternoon. Take care and goodbye.